Learn everything you need to know about the stock market with our beginner's guide.
Rahul always watches the news.
Indian stock market hits record high. Nifty rallied above 18,600 after the pandemic and Sensex hit a record high of 60.
Rahul is interested in learning more about the Nifty and Sensex. Rahul googled and found that Nifty and Sensex are called stock market indices. Rahul wants to know two things. Why do they have the name index? What is an index of the stock market? In general, an index is a tool that shows how the value of something has changed from a certain point. For example, the Consumer Price Index or CPI is a way to measure inflation. A stock market index is a basket of stocks measured together to arrive at a value that will be used to measure the performance of the collection of stocks. By measuring these stocks collectively, indices track how the overall market is performing. Stock indices like Nifty on the NSE and Sensex on the BSE are made by the stock exchanges. Let's look at the different indices that are available on the NSE. We have broad market indices like the Nifty50, which is often called the benchmark index, the Nifty Next 50, the Nifty100, and the Nifty200. These numbers show how many stock companies are in the basket. We have sector-specific indices like Nifty Bank, which is made up of 12 banking stocks and shows how the banking sector is doing. In the same way, we have indices for Nifty Auto, Nifty FMCG, Nifty IT, and many other sectors. The Nifty50 is a group of the top 50 companies on the NSE, such as Infosys, Tata Motors, Britannia Industries, and Indian Oil Corporation Limited. If the prices of these companies' shares go up, so does the value of the index. The 50 companies come from many different sectors, such as banking, automobiles, fast-moving consumer goods, FMCG, information technology, IT, manufacturing, energy, pharmaceuticals, etc., and they are given different weightages based on the sector. Like, financial services 39.47%, IT 15.36%, energy 14.42%, consumer goods 11.04%, automobile 5.43%, construction 3.65%, metals 2.97%, pharma 2.33%, telecom 1.94%, cement and cement products 1.57%, fertilizers and pesticides 0.69%, services 0.64%, media and entertainment 0.49%. The base period for the Nifty50 index is 3rd November 1995, which means from this start point, the index measures the value of all the stocks within the index. Rahul now wants to know how this information on index will be useful for him. First, they are used as a benchmark. Let's say stock X has given a return of 20% per year, but Nifty50 has given a return of 30% per year. We can say that the stock has underperformed compared to the benchmark of 30% set by Nifty50. For example, the Motilal Oswal Dynamic Fund has given an average annual return of 8.58%, whereas Nifty50 has given an average return of 12.2%. After looking at the returns, we can say that Nifty50 has clearly outperformed the Motilal Oswal Dynamic Fund, so there is a chance for the mutual fund to improve their portfolio. The benchmark index like Nifty50 act as a general representation of the stock market. There are more than 2,000 companies listed on the NSE and more than 5,000 companies listed on the BSE. If Rahul wants to see how the entire stock market, like the NSE, is performing, he can not look at all the 2,000 stocks individually. If the index is performing well, it is perceived that the entire stock market is performing well. Similarly, if the index is performing poorly, it is perceived that the entire stock market is performing poorly. Indices provide a wider view of the stock market as a whole. The index reflects the sentiment of the market. It is believed that the economy is performing well if the index is moving up, and when the indices are down, investors are pessimistic about the future trend. Finally, index are used to create ETFs and index funds, which can be used by the investors for passive investment. In the subsequent video, we will study the clearing and settlement procedure.